California's leaders say the economy is growing. They say the population is strong. They say innovation is thriving. But the people with the most at stake, the ones who actually fund the system, are quietly walking toward the exit. This is not a protest. This is not a political statement. This is a calculation. In the last few months, some of the wealthiest individuals on Earth have begun dismantling their financial presence in California. Not loudly, not emotionally, but strategically. And when capital moves silently, systems crack loudly. This is not a story about billionaires. This is a story about what happens when an entire economy depends on a very small group of people who are free to leave. California's governor insists the state is expanding. More people, more innovation, more opportunity. But behind the optimistic speeches, the numbers tell a different story. New reports show that at least half a dozen billionaires have already left the state, and up to 20 more are actively preparing to do the same. Not next year, not hypothetically, now. As a proposed 5% wealth tax remains on the table, those with the most exposure are doing what capital always does. They are minimizing risk. In December 2025, something unusual happened. Public records revealed that multiple business entities tied to Google co-founder Larry Page quietly changed their official addresses, from California to Florida. Not just personal holdings, family offices, investment vehicles, advanced aviation ventures. Even philanthropic research entities stopped listing California as home. These changes occurred just weeks before the proposed billionaire tax threshold date. To tax experts, this was not coincidence. It was positioning. Larry Page was not alone. Peter Thiel, a longtime critic of California's tax environment, expanded his operations in Miami. Sergey Brin reportedly restructured clusters of business entities toward Nevada, a zero personal income tax state. Each move followed the same logic: move early, move quietly, move legally. The goal was not defiance, the goal was insulation. Years earlier, Elon Musk demonstrated what early relocation really means. By shifting his primary residence to Texas ahead of major liquidity events, analysts estimate Musk avoided more than $1 billion in California taxes. That single move became a proof of concept. It showed that residence is not emotional, it is procedural. And once that door opens, others follow. California does not have a revenue diversity problem. It has a concentration problem. The top 1% of earners provide nearly half of all personal income tax revenue, sometimes as much as 50%. Expand that to the top 5%, and nearly 70% of all personal income tax collections come from just 175,000 households. That is fewer people than the population of a mid-sized city. These households generate over $100 billion annually for the state. The remaining 95% combined generate less. This creates an unstable structure. When tech stocks rise, revenues surge. When founders sell, the budget expands. But when those same individuals move, even temporarily, the impact is immediate. Schools, healthcare, infrastructure, all tied to decisions made by a mobile elite. California's fiscal stability depends not on growth, but on presence. IRS migration data shows the pattern clearly. In 2022 alone, over 24,000 households earning more than $200,000 left California. They took with them more than $16 billion in adjusted gross income. From 2020 to 2022, cumulative income outflow exceeded $100 billion. This was not a single event. It was a sustained movement, and the destinations were consistent. Texas, Florida, Nevada, Arizona, Tennessee, all states with zero personal income tax. Texas alone gained approximately $14 billion in net income from inbound migration during this period. Florida and Nevada recorded similar gains. Every dollar leaving California did not disappear. It simply relocated, and with it went future investment, payrolls, and long-term tax contributions. The corporate world noticed. Oracle moved its headquarters from California to Texas. Tesla followed. Hewlett-Packard shifted to Houston. Charles Schwab relocated leadership operations. Most kept operational footprints in California, but headquarters matter. They signal confidence, or lack of it. In 2022, California posted a surplus of nearly $100 billion. 2 years later, projections flipped. Between 2024 and 2025, the state faced deficits ranging from $55 to $73 billion. Analysts now forecast structural shortfalls of $12 to $20 billion annually through 2027. Revenue volatility met concentrated dependence, and the margin for error disappeared. California's largest pension system, CalPERS, carries an unfunded liability exceeding $160 billion. That translates to roughly $6 million per resident. At the same time, despite spending over $24 billion on homelessness programs, the unhoused population continued to grow. These are not moral failures. They are arithmetic realities. In Stockton, a fourth-grade teacher unlocks her classroom to find budget cuts waiting. Art programs reduced, maintenance postponed, uncertainty normalized. Across town, a small business owner watches regular customers disappear. Engineers, designers, professionals now working remotely from other states. Suppliers raise prices. Local taxes loom. For them, capital flight is not abstract. It shows up on invoices and in classrooms. Inside policy meetings, officials run simulations. A modest surcharge on incomes above $5 million could generate $1 billion annually, but each increase raises the probability of exit. Economists calculate that for a $10 billion investor, the difference between California's tax rate and zero-tax states can exceed $90 million per year. Over a decade, that becomes a billion-dollar decision. Proposals now include innovation credits, relocation subsidies, and research incentives. These may slow departures. They will not stop them. Capital is global. Residence is flexible. And planning is sophisticated. No policy can fully restrain mobility without consequences. This is not about whether California survives. It will. The question is what kind of system emerges next. One built on diversification and stability, or one permanently exposed to the movement of a few. Because when an economy depends on people who can leave overnight, every night becomes uncertain. What happens next in California will not just shape one state, it will define how modern economies survive in an age where capital has no borders.